Afternoon, everybody. Hope you can hear me. If you see that I'm talking and you can't hear me, can you type a message on the group chat where somebody can just identify that you can hear me? That'd be great on the group chat. Thanks, Mark. We're going to wait a few more minutes and start shortly. Hope everybody's doing okay. Thanks, Blake. Good afternoon, everyone. We're going to start in a few more minutes. I've got 12:28, so we'll wait a couple, 3 minutes and then get started. Welcome, everybody. It's Jordy, and hope you're all doing well. We'll give I think we're expecting a few more people to drop in, so we'll just wait a couple of minutes. But in the meantime, I'll just go over our agenda. You can feel free to have your logged into eState Planner on your own behalf if you want, but it's not necessary. I'm not going to necessarily be through each example, but you can try it out as you like. And I'm just going to be demonstrating. We try to keep this webinar to half an hour, but then we have I stick around to answer any questions for anybody as well. So we're at 26, and I think we were expecting around that. But, so we'll give it another minute. If hopefully nobody's in a huge rush, but we'll get you out of here by 1 o'clock if you want. So I thought I'll just introduce what we're going to be doing today. These Thursday webinars are on advanced topics, very sort of narrow, specialized topics about eState. And today we're doing asset gifts. And so that's what we're going to concentrate on, specific bequests of assets, as well as trusts for assets as well. So that's the plan. And yeah, so I'm just wondering if there's a way to play and that's what I want. Okay, so we will no longer hear a chime when somebody comes in or goes out, so that should be good. Hopefully everybody can hear me. And I'm going to start sharing my screen. And you should be able to see an asset page for James Jones. So if you can hear me, but you can't see my screen, let me know. Otherwise, I'll assume that we're good. So obviously, if the client wants to give away something, a specific asset, we need to include that asset in our list of assets, right? So I think I've said before that, you know, for those people who don't like to put in all the assets for a client, you don't have to. Obviously, the more information you put in, the better. But if you're trying to give away an asset, then you obviously have to add it as an asset. And you might not find that out until you're down the road a little bit with the client. And all of a sudden they say, oh yeah, and I want my guitar to go to this person. And you haven't entered the guitar as an asset. Well, then you can always just go back to the asset, add, you know, guitar, and that I would put as a personal effect. I'd put it as other general personal effects. And then I just change this to guitar. And put down a value if you want or whatever. And now I have that asset in there and now I can give it away. So just you can do that at any time, obviously. So let's start with some simple ones. So let's just start with the sort of, first of all, joint and designated gifts of assets. So eState, even if you put an asset as joint with someone else, it doesn't automatically put that asset in as a joint asset on the planning page. And we've done that deliberately because that may change depending on the planning. So we haven't put it in automatically. And so, for example, if you want to indicate that the home is joint and you want to demonstrate that, then you can just drag it and drop it in the joint and designated asset, right? And I think I've shown everybody how to do that. So that's how you would deal with any asset. Same goes for assets that have, where you could designate a beneficiary. Even if you put a beneficiary in there in the information, that doesn't mean that it's going to automatically be in there. You've got to demonstrate to the client the impact of that and drag it and drop it, okay? So those are joint assets. So the place that we typically give away assets in the planning is in the initial gifts, right? You're not going to do this in the balance of the estate. You're going to do it in initial gifts. This applies anytime you're dealing with a specific asset. So the one that I almost always deal with are general personal effects. That would cover everything, all of the personal effects. And I would typically, in the surviving spouse, simply make the spouse, Jane, the absolute gift beneficiary of those. And that's how you would create a gift. You would simply drag, I'll just demonstrate that one more time. You have your assets along here. We want to make a specific asset gift. We click, we drag, we drop, and then we fill in the information about who the beneficiary is and what type of gift it is, right? So that, and it then is displayed. So that's how you make a very simple gift of, for example, personal effects. We're going to get a little more complicated now. Any questions to start before we get into the sort of, let's go to descendants only where we might, well, let's go to surviving spouse. Let's create a trust for the spouse. So this is pretend it's a second marriage, and the instructions are that you want to, we want to give away the home, but we have a but attached, right? The spouse can live in there, but eventually we want it to go to the kids, for example. So the way we would do that is we'd click and we'd drag the home and drop it into the initial gifts asset box. So here is the typical initial asset gift box, and you have your choice between an absolute gift or a trust. Well, let's just, as an example, let's start with an absolute gift. Okay, so we're going to pick Jane as the beneficiary. We want to give Jane the home, and then we can go to conditions. Now, these are things like you get the home as long as you pay the income tax or pay the probate tax, or you deduct it from your share of the residue, and that might not be applicable in this situation, or you assume the mortgage, or other. And I'm going to go through some of them in a minute. But so that's, and then you just provide for a gift over. If Jane's not alive, who do you want it to go to? Well, I just want it to fall into the residue. So that's how you create a very simple gift of whatever it might be, the bank account. You can do that as well. You can say, I want that bank account to go to, somebody on my list, Elizabeth, and click whatever options. Now, probably wouldn't have an income tax issue, but you want to deduct that from her share of the estate. And I'll show you how to do that in a second. And then you'd want to provide for a gift over if she's not alive to the residue. Okay. So those are very simple gifts where you're not making any conditions, you're not setting it up in a trust or anything like that. Okay. Let's just stop there for a second and see if there are any questions. And I'm just going to open up the dialog box so people can see it and then say, do you guys have any questions about, and we're going to get to conditions in a moment, but about just how you create a gift of a specific asset. Any questions out there? And Michaela, if you can unmute everybody. Maybe I can. Anybody have any questions?
Jordy, what's the difference between a special provision and a condition?
A special provision would be something that's not a condition. So if you want to put in here something, there's some sort of crazy idea that's not that you wouldn't put as a condition. I just always wanted something in there to take even for notes. This asset, asset is whatever. And so that you can try. And quite frankly, we're going to generate this and figure out if that does anything in the actual document. Because I think what we've done is I think it comes out as a highlight. But that's what I would put in the special provisions if there was something that wasn't a condition.
Okay.
Jordy, I left you a message on the chat. What happens if Jane doesn't want the house for strange reasons?
Right. So there is a provision in the draft that talks about disclaimer, that if a person disclaims a gift, then it would be as if they predeceased. So I would deal with that in the gift over.
Okay. Okay, there it is. Okay, got you.
Yeah. And that's something where I would put in the special provisions. Like I put a note about that, if that's a possibility. But the way the will is drafted, it says if a beneficiary does disclaim, it's as if they predeceased.
Oh, but if there's, for instance, several properties and he or she wants to disclaim on one of the properties, does it the predeceasement only occur to that one particular gift or to all the gifts? Yeah,
you're allowed to disclaim specific gifts and not others.
Okay.
So let's get into a little bit more complicated. Let's go to the descendants only. So let's do a gift, a conditional gift. Okay. So let's say we want, let's go with the country house. Okay. So the instructions are, I want one of my kids to get the country house. Okay. As long as they pay the income tax. I'm just going to mute everybody while if that's okay. So we're going to drag and drop the country house in here because we're giving that away specifically. There's some conditions. So the beneficiary is Frank, and it's an absolute gift, but there's a condition on. And the condition is you get it as long as the income tax that's triggered on the home is you cover it. And if you don't get the gift, right? That's a very useful one where you don't want the burden of the income tax to fall on the residuary beneficiaries. Okay. I'm just going to show you something. If I just add that and I go to my warnings, it will warn me about the fact. So if I did this and I didn't even discuss it with the client, yeah, I want Frank to get the country house, and you didn't even think about the income tax implication, eState will warn you about that. Just make sure you've considered it. If maybe it's not, maybe you're fine with the residue. That's one of those things I would keep a very careful note on, that the client did want to have the residue pay the tax on that gift. So let's go back to that and change that. We now realize, oh, we better think about the income tax. And when we raise it with the client, they say, yeah, I want him to pay any income tax. So we click on payment of income tax. I'm just going to disconnect. You can put other conditions, like another condition is you deduct it. Let's go to, well, let's leave it at that for a second, payment of income tax. And then you do a gift over. So again, if Frank's not alive or doesn't fulfill the condition, who does it go to? So that's how you would do that. And then what it would do is it would generate, and I've got a pre-made, I always think of this as like a cooking show, and I've got it pop out of the oven. And let me just find out where the condition is. If I can find it, I think I did one here. No, hang on, it's one of these other ones. Bear with me for a second. We want a conditional gift. nope, not that one. Should have marked these, eh? Here it is. So, oh, no, that's not it either. All right, I'll find that for you, where it's a conditional gift. And it does basically say, look, you get, and we'll generate this, but you get the asset as long as you pay the tax, okay? So another condition that I want to just go through is this deduct value from beneficiary share. So the client says, look, let's get rid of payment of income tax for a second. And the client says, look, I want them to get the home, but that comes out of their share of the estate. So, that's how I want it done. And you explain to them, well, okay, there's going to be other ramifications of that, but let's go through that. So we go add, and we want to deduct the value of the home from the beneficiary's share. So we have two choices here. We can either do the option to purchase. So we say to them, look, you have the right to buy the home from the estate, and therefore that automatically means that it's going to be part of their share of the estate. So that's one option. Or a less stringent one is a hodgepodge clause. So let's just do that. And it asks you things like, okay, if we're going to hodgepodge it, then it could be that that the purchase price actually exceeds the share of the beneficiary. So if they're in for a third and the home is worth 100 grand, but their share is only worth 80, well, then the hodgepodge won't necessarily work. So question about whether you want to build in some sort of security for the payment of that if their share is less than the value. The other thing that you might want to build in is, because if it's just the pure value of the home, which is 100 grand, the estate is still responsible for the income tax. So that might not be fair. So you might want to build in a fact that they've got a hodgepodge not only for the value, but also for the income tax implications and payment of estate administration tax, as an example. And you have the right to say, okay, you get it at whatever the fair market value is at the time of my death, or you can fix the amount. So in other words, you get it for 100 grand and that has to come off your share, but if it's worth more or less, that's, I don't care about that. And then there's similar provisions for in the event, if it's fair market value, how that's going to get valued. Is it going to be by appraisals selected by the trustee, and maybe it's 2? And what are we going to do? Are we going to average it, or is it going to be some other resolution? Are we going to discount for notional commission because they're getting it and they're saving the estate commission? Things like that. So that's basically how you could do that. And the wording for that, I'm just going to save that. The wording from that, and I did do it here. I just got to find the right version. So this is it. So this is an example of the wording for a gift of an asset that's going to be deducted from the value of from the beneficiary's share. So in this case, it was like corporate shares. But what I was saying is, look, you get it as part of your share. That's my intention, without negatively impacting the other beneficiaries of my estate financially. So take into account not only the fair market, but any income tax, probate tax, etc. So because I checked that off, that's what I want. And I expect that there is a simple way of doing that. But if there's a huge fight, then I build in this option to purchase. So in other words, I want them to be able to get it. If they can't come up with a simple way to do it, I've given you a chance, but if not, then here's a more complicated way, and it's going to be more expensive and things like that. Okay? That's sort of how that provision would come out in the document. So let me just unmute everybody.
You are unmuted.
Anybody have questions about this idea of giving a gift, but deducting it from the beneficiary's share?
Somebody had a question in the chat box just about whether or not eState deals with the HST on the commission, if you're adding that in.
No, actually, it would just say deduct less 5. The way it works is it says less 5% of the value of the, or whatever percent you put in of the value of the property. I've actually never seen it deduct. I mean, you could set the amount at whatever rate you want. So you might not want to deduct the full commission. You might want to make it 5% or 6% or whatever. So no, it doesn't necessarily say 5% plus HST on 5%. I guess you could do the calculation and just put it in as a percentage, 5.13 or something. I don't know what the percentage would be, but it's a good point. But you could do it if you use the standard language.
Or you could also just draft it in yourself.
Yeah, you could draft it. I would prefer just use a percentage. So it's X percent and figure out what the HST would be on that percentage and just build that into the percentage. So it's 5.06% of the purchase price or whatever.
Or simply just state 5% plus HST is applicable.
Sure. Yep.
Jordy, isn't the appraisals going to be required anyways for the administration of the estate for both the estate administration tax and or the income tax?
Yeah, it may be. People, if it's a principal residence, for example, they don't get necessarily a full appraisal. Instead, they just get a letter of opinion and do on that. But yeah, I mean, they might. And they could use that appraisal. It doesn't say you have to get 2 additional appraisals that you didn't already get. I don't think that's. I'll show you though how that option of purchase works and appraisals work in a moment. Yeah. So let's. I'm just going to mute everybody for a second, and I'm going to open up my chat somehow, which I can't seem to. I'm going to get rid of this. Give me one moment here, and I'm just going to check that I see a bunch of chats. Sorry, I didn't have it open, and I apologize for that. All right. So let's just get to, let's change this now to a trust as an example and how we can do that. So give me again 1 second, and I'm going to go like this. Okay. So this is now, let's do a sort of a more simple situation. So we want the home or the country house, let's say, to go to the kids in trust for a period of time until they can decide whether they want it or an age. And now we want to, and then they can, one of them or more of them can buy it. Let's say, take that as an example. So beneficiaries, we change it to a trust, right? We drag the country house in, we change it to a trust. We'd say, okay, we're going to use a class gift. We're going to say children. Use by, who can use the property? Well, the children can use it. Termination view. So this is when the trust is going to end. So let's build in a few. So age of beneficiary, let's say 25. So when all of my kids are 25, that's one condition of it ending. Another is they all agree, unanimous agreement, or you could do a majority if you wanted to do that. You type in here, you just type in a majority of the beneficiaries. But probably you want to do, I typically say unanimous consent. The other one is, trustee's discretion. So if the trustee feels that it's a good time to sell, then they can sell. And it's going to pick the earliest. You could alternate between earliest or latest, et cetera. Then we go to the idea of the expenses. It knows it's real estate, so it knows that there's going to be expenses on the property, and so you can allocate them. So you could say, look, I want the beneficiaries to pay 60% of the ordinary repairs and the estate 40%, or I want all of the property tax paid by the beneficiaries and nothing paid by the estate. And you can allocate these all out. Let's keep it for now. Well, let's just keep it there. You can also very simply, if you want the beneficiary to pay all the expenses, you could just click on the all and they'll all be paid by the beneficiary or all by the estate, just by clicking this box. If there are expenses here that you want to deal with that aren't listed, then you can add them. Condo fees, and then allocate those, and you can delete them, etc. And then it asks you, okay, where is the estate's? They're paying a whole bunch of expenses. Where is that coming from? Is it coming from the residue, or do you want to set up a separate fund? So if you want to set up a separate fund, you're going to go to provisions and add. And what I typically do is go straight to amount. And you can either fix the amount. So I want to leave, $50,000 in this fund, or I can choose to leave it to the discretion of the trustee and go done. And now the trustee is going to deal with that. Okay. Any balance owing or left in there at the end will automatically go with the gift over. So then you have other options, like, do you want to be able to buy a replacement property? The trustees, can they sell that property, buy a replacement property? Is the beneficiary's consent required to that sale and repurchase? And so you can play yes or no. And the other thing you can do is specify, okay, if there's excess proceeds, and just so you know, this is how it's going to work for all proceeds, but for right now, it's for when you sell and buy a replacement property. You can either have it fall into the residue, or you can designate a specific distribution, which opens up basically like a brand new residue gift, which you can divvy up among the other beneficiaries. You could put 50%, to this person, and then add, and then another 50% to, or 25%, whatever, to Rachel, and that's how you can give away the excess proceeds. And again, this is how we're going to build it in for any proceeds. So where we direct the sale, for example, and we don't yet have that, but when we direct the sale, you'll be able to apportion the proceeds. And then the last question is, do you want an option to purchase? So let's just go through this for a second. So this is at the end of the trust. Do you want any of the beneficiaries to be able to buy it? And so what we would do here is if more than one wants to buy it, we have this resolution. And you could either say they have to buy it together. You could set the order of priority. That only works if you've named beneficiaries directly. So it doesn't allow you, if you picked a class gift, because it doesn't know who's necessarily in the class, you could have future members. And so it's going to you can't really use order of priority. If you want to use order of priority, then you have to name the beneficiary specifically. And then the third option is this idea of random selection. And that is, you pick if 3 people want to buy it, you pick the name out of the hat and they're the ones who can buy it. We're adding another option here. And if anybody have other sort of suggestions for that, we welcome them, but we're going to add some more flexibility into that. And then what purchase price they can buy it at, and how the purchase price is going to get determined. For example, it's similar to the one I just showed you in the deduct notional commission. So you can do, now the problem is right now you can't do here, you can't put anything but a number. So if you want to type in 5 plus HST, you can't, it doesn't allow that. You'd have to do it in the document itself, but you could do this. No, you can't, 5.1%. Interesting. Okay, so that might be something. If people want to have that, we can build that in as a feature. Next, do you want the beneficiary to also be able to get their own appraisal if they don't agree? So there's, a timing situation. So, how quickly do they have to get their other appraisal? And then who's paying for that? Well, I'd want the beneficiary to pay. If they're getting their own appraisal, I want them to pay. And then the next option is, how quickly after they know what the purchase price is, do they have to decide? So do we give them, 15 days after they know? You can set that. And then here is, how quickly after they exercise their option do they have to close? So they get 30 days to close. And like excess proceeds, you have the right to distribute on the option to purchase. Where is that money going to go? Is it going to go to residue? Is it going to go to other people in different distributions? And that's the specific distributions. And then the last point is the gift over, and that might just fall into the residue if everyone's gone. And that's the way you create a home trust for the children with an option of purchase. So I'm just going to unmute us.
You are unmuted.
I should warn everybody before I do that, but so questions about how trusts get created for a property. And while I'm asking questions like that, I'm going to just show you the way this works. And I'm going to go to a property trust here. I'm finding it. Give me a moment.
Yeah.
Any questions, guys?
It's looking good.
Okay. I don't think I did one.
So Jordan, you didn't talk about the discount for partial interest. I'm wondering about the distribution of the proceeds when that happens.
So the reason, I'm just going to mute everybody for a second. So I'll get to that. Give me 1 second. Okay, so the discount for that's in the valuation. So let's say you own 4% of a property. I think that's here. So let me just go to that. You own, 4% of a property. When you're evaluating it, do you discount? So is it 4% of the total market value of the property, or is there some sort of discount because you only own 4%? So not necessarily without this, if I don't check this off, they're basically going to take the fair market value, multiply it by your percentage interest, and that's going to be the purchase price. If you do this, then there's going to be a reference to discounting it for a partial interest. And then that's kind of up to the appraisers to figure out how to do that. That's why I built that in. That's the concept there. Often I don't check that off, but that's the concept behind that. So let me unmute everybody.
You are unmuted.
So sorry, now here was, I gotta just remember which one it was. I think it was here. Okay, so here's the, right here, here's the option, the gift of the home. So starts up here, and it says, okay, with respect to this property, now it's gonna take the municipal address of the property. So I think I've mentioned before that if you're ever giving away a specific asset, you should fill in the address, because it's going to try to fill in the address. If it's empty, it's not going to have anything there. It highlights a few things, like you should enter the PIN number. Eventually that'll be in the portal itself, so it'll do it. And then here you see the replacement provision. So it's not only that property, but any property purchased in substitution for. Here are the home beneficiaries. Here was the disposition date. Now this isn't the same one I just drafted, but you can see here was the earliest of when they're all 30, when the trustee's discretion, and here is when we had a majority of the home beneficiaries advised by trustees that they don't want it. Otherwise it would say all of my trustees. And then here's the trust, right? Hold it for the use of the home beneficiaries. And here's the expenses being paid. And this was out of the residue. So this is the typical residue clause for payment of expenses. And then here's the right to purchase the sell and buy a replacement property, and how the excess proceeds are going to get dealt with. And here's the grant of the option to purchase. So it gives some options here. Here I had typed in where I wanted there to be some other, instead of averaging it, I wanted to put something in there. So I'm going to have to draft that myself if I want some other way of picking the purchase price instead of just averaging them. And again, we're going to build, as people develop this and use it more and want other features, then we could build that in as options that you pick right in the portal. And here's the option to purchase, and the way it prints out, less 5% for notional commission. You could put in, less 5% plus, HST if applicable. I don't know, whatever you want to type in. Of course, you can always edit this document, and then how they do it. I didn't provide for a gift over or anything like that. So that's, I'm going to unmute everybody. That's how that works. And I'm just over 1 o'clock, so I wanted to at least stop the formal part of it, but I'm here to answer questions if anybody has additional questions or scenarios they want to try. But that's the essence of how you make specific bequests of assets in the initial gift section. Happy to take questions now, but feel free if you want to get going. feel free to jump off. And next week we'll have another one and on an advanced topic. And again, I encourage you, jump on a tutorial. If you have a question about a specific gift you're making and we're not on a webinar, you can always go to the support tab. And I'll just show you where that is. If you go on the main page to support, if you're on there for 5 seconds or something like that, up will come a little chat box, and you can chat. There it is, and you can chat directly with one of us. Usually it's Michaela if she's available. You can leave a message, and we can get right back to you on answering you any on any specific question. So that's how you get to us, but you can always email us. You can book a tutorial if you have a bunch of questions. It doesn't have to be a full tutorial. It can be, you can just book, a 15-minute tutorial, and Michaela will work with you, or I can get on if it's more technical issues. So please don't hesitate to do that. For those of you who have used our support, I hope we generally get very good feedback, and we want to be here for you. We can help. So I'm going to stay. Yes. So the good question about first dealings. That's going to be an option in the asset box, so you'll be able to check that off. It's also going to remind you to check with the client based on how long they've owned it. It is a very good question. So we've got that on our list. For sure, we will do that.
Jordy, I had asked a question kind of up higher in the chain. And
sure. Good. Yes, please.
So we've had a scenario where either in the descendants only or no descendants scenario, the clients want to leave a couple of specific gifts, but then they want to leave all of the other assets unequally.
Yes.
To other family members. So do we just not gift those and then deal with it through segments as the residue?
Yes. Yeah. So what you would do here is, let's say they want to give, I don't know, the bank account, like, is it a specific amount? Is it a cash gift or an asset legacy?
Jewelry.
Say again?
They wanted to give away specific jewelry and then leave other things just to everybody, but unequally.
Yeah. So here's what you would do. Jewelry to Rachel. Then everything else, which is the balance of the estate, add a segment. This is 24.5% going to this person. And then we go, now I got 1.8% going to, this person. And then I got whatever. And then it'll do it that way. And that's how you do it.
Okay, perfect. That's what I did.
Because that is a residue gift, right?
Yeah. Okay, thank you.
Yep. Other questions? And the other thing to point out is, based on what you're doing, I mean, I always caution my client about giving away specific assets. It causes, of all the things that we can do that seem simple, it's the most complicated. Even the simplest gift of an asset is the most complicated because of at least three issues. One, the income tax and other costs associated with that gift that typically, unless you deal with it specifically, comes out of the residue, affecting the residuary beneficiaries. Two, the issue of redemption. So that asset not existing or changing its form or something like that. And then three, the change in relevant value of that asset. So, maybe there should just be a huge warning if you try to give away a specific asset that, this is just remember to go over these issues with the client. And those are the three ones that are most important. What about, redemption, what about income tax, and what about relative value? So I always discourage my clients from doing that unless there's a really good reason. And at least the good news is that it does, it does warn you about the income tax, which is likely the biggest, it can be a double whammy, right? Where the residuary beneficiaries get the have to bear the burden of the income tax, and they don't even get the asset. So that's why that's a major warning. And I once did an article, I think it was in Law Times, about why such a simple gift can cause so many problems. And at some point I can send that around to anybody who's interested. But really, whenever a client says, and I want one house to go to one person and the other house to go to the other kid, like that's a red flag for sure. The way to deal with that, especially if you ask them, well, are you trying to really equalize things? Yeah, I want this to be equal, but I want this person to get the gift. Well, that's exactly the time when you create one of these gifts, right? You create, let's say the home, I want one kid to get the home. That's exactly when you make this condition to deduct from beneficiary share, right? And you build in either an option to purchase or a hodgepodge. Because what they're saying is, I want them treated equally, but I want them to get that asset. Well, that's different than just an absolute gift, right?
So you can partly deal with that by just making a specific gift always conditional on the beneficiary paying the tax.
If tax is only, yeah, if unless they don't want, unless they don't care. I mean, it's just a very important issue. But yes, I would, if the client ever said to me, no, I don't care, I want the residue paying the income tax, and have it. Sorry, guys, do you mind just muting your phone, sir? I would just say, you know, if they didn't want the gift conditional payment of income tax, I'd make a pretty good note about that, and I'd write to the client. So yeah, that's
also mitigated if you're leaving gifts to charity, where then you're going to actually maybe get an income tax receipt as opposed to having to pay income tax.
Right. So that's a good, well, that's a good example. You know, I don't think we deal with that specifically. But yeah, there's a benefit obviously, but there's a benefit to the residue for that for sure. But that's shown. So if I gave something to charity, that would be shown as in eState down here as income tax saved. So, you know, because it does calculate the benefit of that.
So once you see the difference, you know, if you've left several things to charity and then several things to specific individuals, you'll be able to see the tax burden and then plan for that.
Correct. Okay. So if I give you know, 1.5 million to a charity, for example, you know, I've just saved you $660,000. Right. So it demonstrates that. And I'm not, to be completely honest, I'm not sure. Let's try this. I'm not 100% sure if we give, let's try an asset with some tax. I don't know what I have has tax. Let's try the shares. Okay. Let's do this. And this is where we're going to probably have to improve it a bit, but let's give the shares to a charity and see what happens. No. So what we have to build in, that's good, good test. What we're going to build in there is not only the impact of the bequest, but the impact of the income tax as well. So I better check my list and make sure that's on my list.
Jordy?
Yes.
It's Kit. A question there. So that was a gift of private company shares. Would the result potentially be different if it was a gift of publicly traded shares?
Right. There would be a different. And now the question is, I don't know, and I'm going to investigate this right now. Actually, is the income tax implications of those gifts? So let me get on that. But obviously, it would depend on the type of shares and the type of gift.
Yeah.
Sure. Yeah.
Jordy, question for you. When you selected the charity on the list.
Sorry, couldn't hear that. I have two people calling in. Say again?
When you select the charity from the list.
The charity comes up on the list. Is that what you're asking?
Yes.
Okay, so here, let me just demonstrate that then. So in your system, if you add a new charity, the first time you add the new charity, disregard this box for now, okay? The first time you added a charity, let's say you know that the charity, you check and here's the charity's name. what I do is I then put in the, whatever the registration number is, okay, in brackets like that, and I add them. That will always now show up as, once you put it in once, it will always show up. There you go.
Okay, so my question was, given that the charity will always show up, will other people's names show up? Other clients' names?
No, just charities. So
okay.
In this list, you would never see anybody but the people in this client's family tree. Or, that is definitely not shared. That is segregated. It's only charities that might be available throughout, that are saved.
Perfect, thanks.
So, Gordy, is it wrong to do it in a way that you add the name of the charity and then you add in their registered ID for charitable purposes on that other line?
Yes, don't do that. Sorry. I've told her, I have asked our dev team to delete that because it doesn't put it in anywhere. So we've been debating on whether we should keep it and put that in or not. So now put it in the name.
Okay, thank you.
Sorry. All right. So any other questions? Well, thank you all. Again, oh, there's one more chat here. Oh, no, nothing. Thanks again, and hopefully we'll see you again next week. And if you have questions in the meantime, please email us. Thanks again, everybody. Have a good afternoon.
Thank you. Thank you.